Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, the market strategist here at Zephyr. It's been a very interesting first 7 months of the year. The current macro backdrop has made investing in fixed income very interesting, as some fixed income experts have said this is the golden era of fixed income. Well, our next guest is an industry expert who's going to help us get a better understanding of the impact the macro uncertainties have on fixed income markets, the uncertainty or the opportunities that are available, and some tips when it comes to diversifying across fixed income for financial advisors. But first, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. All right, enough from me. Let's go ahead and get started and bring on the star of the show. I'd like to welcome Mike Sanders. Mike is the head of fixed income and portfolio manager at the PSN Top Gun award-winning Madison Investments. Yep, you guessed it. Mike is coming from the best college town in America, Madison, Wisconsin. So, Mike, thank you so much for coming on the show. It's an honor to have you on. Can you tell us a little bit more about yourself and Madison Investments?
Yeah, thanks for having me. Great to be here. Great. Madison is a fantastic place to be for sure. I've been at Madison Investments since 2013. Came in as an analyst and then became head of fixed income 5 or 6 years ago. Madison is based in Madison, Wisconsin. We've been around for 50 years. We celebrated 50 years in the last year, which is great. We have around 29 billion in AUM as a firm. We manage both fixed income and equity strategies, and about 11.5 billion of that is on the fixed income side, and the balance of it is in equities. We are big believers in active management, higher quality investing, participate and protect. Best way to make money is not to lose it type philosophy, and I think we do a fantastic job across all of our strategies in doing that. We offer various vehicles for our strategies, separately managed accounts. We were one of the pioneers in that market, launching fixed income separately managed accounts way back in the 1990s. And we also have mutual funds and active ETFs. So we do a little bit of everything, and we do a great job.
Yeah, that's fantastic, Mike. I'm glad that you mentioned the different vehicles. Now, active ETFs are just making waves and capturing headlines. But, at Zephyr, we have the PSN separately managed account database. So we're very big in the SMAs. I'm glad you brought up SMAs that's one of the vehicles that you offer. Can you maybe go in, why have you guys been out? You said you're kind of the pioneers in SMAs. Why is that? What characteristics of SMAs do you believe fixed income is a good vehicle for?
Yeah, so I mean, it really depends on what kind of access to the market you want in terms of different securities. I mean, certain parts of the market just aren't available on an individual basis, so those might be better in a fund or an active ETF format. But in a lot of the higher quality type fixed income markets, a separately managed account is fantastic. You have a lot of transparency. You have the ability to see exactly what you own. How we trade and manage those portfolios is we're getting institutional level allocation and execution and allocations given how we trade all those accounts. And so you get a lot of benefits to that, the transparency, the execution, fee differences in some instances as well. And so it's a great option for a lot of investors. But there's obviously reasons to use funds and ETFs as well. It kind of depends what you want from an exposure perspective.
Yeah, exactly, Mike. And like I said at the beginning, you're the portfolio manager for some of these strategies that have been awarded PSN Top Guns this past quarter and previous quarter. So winning by not losing is working really well for you guys
Yeah,
and your teams across the board. So congratulations.
thank you.
Let's start at the top and talk about the major macro themes that investors have to contend with because there's a lot.
Mhm.
Can you just maybe provide us quickly with your views on the macro environment?
Yeah, it's definitely an interesting time on a macro space. You have really you think about the Fed's dual mandate of employment and inflation. And you saw some commentary yesterday from the FOMC and how Powell's viewing what's going on in the economy. And you have the labor market, which is more or less in line with what the Fed thinks is in a good place. It's
Mhm.
probably weakening a little bit. There's probably a little bit less labor supply, but there's probably also less labor demand, but there's also less labor supply given some of the immigration policies going on.
Yeah.
So net, it's probably balancing itself out, maybe weakening slightly. But if you turn to the inflation side, inflation is still above what the Fed's target is of roughly
Mhm.
2% on a PCE basis. In fact, this morning we had the look at PCE core for the month, and it came in on a year-over-year basis of 2.8%. So definitely above what the Fed wants. So, if you're the Fed, you see inflation is above target. You think the labor market maybe is slowing a little bit, but roughly where a good place would be for them. And you see tariffs down the road and all the consequences that could come from those. And so you probably have to really sit and just watch and see what happens the back half of the year. I mean, Powell in his commentary, I would say, was a little bit hawkish versus what maybe people thought would be the case. He was kind of non-committal to September and made the comment, we'll have more data coming through the next couple of months for to help them make their decision. You did have two dissenters,
Yeah.
which was kind of an interesting thing. It's been a long time since that's been the case, and we'll probably see those individuals get on TV and get in the media and kind of explain their position. So there'll be a little bit of back and forth, and we'll see kind of how it all works out.
Yeah, it's interesting. I'm glad you brought up the Fed. Like you said, they just came out, kept rates unchanged at that 4.25, 4.5%. Well, I think it's been 32 years, I
Mm-hmm.
think, since we've had two Fed officials dissent, which is really interesting. What are your thoughts? Do you think, everyone has their view on the Fed? Are they doing the right job? Are they not? There's a Fed mistake. Do you believe, where do you sit on that line? And do you think we're going to see some cuts moving forward? The Fed base, kind of in their statements are kind of, I feel as if leaning towards or getting markets ready for a rate cut here at the end of this year.
Yeah, I think the Fed was definitely behind the curve when they were behind. They didn't raise rates with the inflation picking up, and I
Mhm.
think you know, they might be a little late in cutting rates. I think the economy is slowing given the uncertainty on the tariff side. I do think the Fed will deliver some cuts this year and some cuts next year. I think the magnitude and the trajectory of those cuts is going to be really dependent on the labor market and how far away that dual mandate, which side of the dual mandate gets from what they want, from what their targets are. I mean, if I'm a believer that if the labor market weakens, we'll get numbers tomorrow, we'll get some other numbers next month on the labor market, but weekly claims are still doing okay. I'm a big believer that if the labor market does weaken, the Fed will cut rates.
Yeah.
They'll look through
Yeah.
some of the higher inflation and they'll want to, cut interest rates to help the labor market. And so I do think they'll deliver the cuts. And that should be good for bond investors, quite frankly. I mean, we'll talk about this in a bit, but I mean, cash rates will be going down, and I think, it'll be a good time for fixed income investors. And as long as we don't go into a recession, yields should be at a different level, a decent level to kind of continue to clip
Yeah.
some really good coupon income and give yourself a little bit of a hedging benefit versus maybe the equity markets.
Yeah, fantastic. You talked about cash potentially, and during our pre-call, you made up a very good point and brought up a very good point, and it was really interesting about cash. There's still a lot of people sitting in cash, you said, which caught me by surprise because you think, you talked about the rates, they're attractive. Real rates are attractive for the first time in how many years? You would think now would be a good time. People would be flooding into fixed income. That's not the case. Why do you think that is? Why are investors still hesitant to put their money to work?
Yeah, I mean, I think if you look at cash rates, you're still above
Yeah.
4%. And, I think a lot of individuals just focus on all-in yield and don't maybe think about the yield plus total return opportunities in fixed income. if you go back to, middle of 2024, we were sitting with the Fed funds rate at, much higher levels, north of 5%. And kind of the same argument was being made with a lot of individuals saying, well, I'm getting paid above 5% for my cash
Yeah.
investments, and I'm just going to sit here. But then you fast forward to, the end of the quarter, and if you look at intermediate high quality fixed income, it was up almost 7%. So, and it's just, you're never going to pick the top or the bottom when it comes to investing. And, in a lot of ways, cash is, people like view it as an option, because of the yield, but doesn't provide hedging benefits. It doesn't provide other opportunities for performance. And so, um, I think with the Fed probably cutting interest rates, cash yields falling, you can still, put together a very, attractive intermediate high quality portfolio that, is going to be at cash levels, but you're going to lock that in for multiple years and then provide an opportunity for the managers to, drive performance in different ways. So I think just the all-in yields are attractive for investors to view, but I think there's a little bit more behind the curtain when you think about what fixed income can provide for a portfolio right now, overall asset allocation.
Mike, that's fantastic. I'm really glad you brought that up because a lot of people, right, you're just talking about clipping the coupon, but there's that total return opportunity, especially you think if we do fall, for one, now that interest rates are and yields are at very attractive level, if we do fall into a recession or something, there's some room there for total return, unlike, when we're at 1%,
Mhm.
zero, and that wasn't very long ago.
Yeah, there was no income in fixed income, we like to say, and now there is. And investors, to your point, can get, a good amount of coupon income with other opportunities on
Yeah.
top of that.
Yeah. Fixed income now, they were saying for years the 60/40 portfolio is dead. Fixed income, like you said, is not doing its job, but it's doing its job. A good hedge,
Mhm.
could be a diversifier moving forward. So it's an attractive place. Speaking of that, most would agree at the beginning of the year, like I said, uh, there were attractive total return opportunities. Treasury yields were at attractive levels. Real yields were relatively attractive. But the credit spreads were somewhat narrow. What's your view on fixed income 7 months later? Now I can't believe we're 7 months into the year already, but
Yeah.
we still very attractive here after 7 months and a lot of uncertainty.
Yeah, it's definitely been an interesting 7 months. Go back to April and all the volatility we had with spreads widening and, the general uncertainty when the tariffs were announced. Fixed income's had a pretty good year so far with, some more income opportunities down the road. I think credit spread perspective, we've retraced pretty much all the widening that we
Yeah.
saw back in April, and now we're very, very close to very tight levels of all time. If you look at it on a historical percentile basis, spreads are in the single digits on a percentile basis, meaning that they've been wider 90+% of the time and only tighter a couple percent of the time. So it's they're attractive all-in yields, and I think if you're very smart about, managing your credit risk and looking for good opportunities within the credit markets and not just buying everything, I think there's opportunities for great total returns going forward. But I think you have to be, opportunistic, and it's not a, blindly buy everything market. I
Yeah.
mean, there's definitely going to be winners and losers when it comes to the tariffs down the road, and all the kind of the economic uncertainty that's going to cause. So, from our perspective, again, being active managers, it's a great time to be an active fixed income, picking winners and losers, lots of different levers to pull, from a total
Mhm.
return perspective, rolling down the curve, extensions, everything is kind of open now that you have a more normally shaped yield curve. And we think it'll become more normally shaped as the Fed continues to deliver some cuts this year
Yeah.
and into next year. So, yeah, we've had a great run so far. Spreads are tight, but we still think there's some opportunities to generate some good performance and diversify your
Yeah.
portfolio.
I'm glad you brought up credit spreads and spreads in general. That was exactly where I was going with the next talking point. You sent over some great information about spreads too, about how, like you said, we're at historically narrow levels. And being credit spreads are so narrow, it's kind of surprising. Are there opportunities? Are investors being rewarded for taking that credit risk at these levels when they're so narrow?
Yeah, I think there's definitely opportunities, but again, being the active and making sure you're doing your work with respect to credit research is definitely a key right now. Overall, we prefer, financial bonds more so than industrial bonds. We like the banks. We think there's that little extra spread you can earn, high quality entities, and there's, the possibility for some good total returns in those types of securities and those strategies. Industrials, there's still pockets of value there, but I think, you're seeing a little bit more M&A activity getting announced, and normally when M&A activity happens within an industrial name, sometimes that's bad for the bondholders because more debt has to be put on the balance sheet, and that could cause spreads to widen. And if it doesn't work out, there's obviously issues down the road. So there's definitely pockets of value within financials and within the corporate market and other parts of the industrial market. But again, there's going to be winners and losers given what's going on in the economy, and it's up to the manager to make sure we're figuring out and doing our research because, like I mentioned before, we're the higher quality participant and protect. I mean, in fixed income, you get par back at best, right? You get your money back at best, and you get a lot lower in the worst case. And so we're cognizant of that. We know why individuals want to allocate to fixed income. It's to generate income and provide some hedging opportunities versus their equity portfolio or other parts of the market. And so, you don't want to be extending your risk profile to squeeze out a couple of extra basis points right now because spreads are tight, and
Yeah.
you're not getting paid nearly as much as maybe you would have or should be, going forward.
Yeah, Mike, that's fantastic. And like you said at the opening too, about active management, fixed income is one space where I think active management really you benefit from active management. There's so many different elements to fixed income other than just, picking stocks. I'm not saying picking stocks is easy. It's definitely
Mhm.
very difficult, but you have to worry about so many different things with fixed income. So active management is where they go. And then you mentioned, you guys focus on high quality issuance, which I've heard a lot about, this year is going high in quality. But let's talk about lower quality high yield bonds real quick, even though you focus on the high quality issuances. Do you believe these lower quality sectors provide attractive return risk opportunities? Again, even high yield bond, the spreads are very narrow. It's not like you know, you, they're showing much concern over the economy for how narrow they are.
Yeah, you're right. They're definitely narrow, and some of those charts you had referenced and mentioned definitely show that we're in that very low percentile on a historical basis. I think, there's obviously good names within the high yield space, but I think the thing that investors really got to think about with how tight spreads are today, if you look at the correlation of high yield corporate bonds to, let's say, equities, it's pretty highly correlated relative to more higher like investment grade and treasury parts of the market. So you're kind of investing in an equity proxy in a lot of ways with a little bit more yield. So, if you're thinking about building an overall asset allocation that kind of, balances each other out in good times and in bad, if you're weighing more into the lower quality credit space and there's volatility on the equity side, you're kind of losing on both sides of your investment. Your equity portfolio is going down and your high yield portfolio is going down as well and not really providing that hedge. If you look at, parts of, during the COVID issues, you look at a little of the time during the April volatility from tariffs, and in 2022 as well, right? There was just the correlation and benefit was not there for parts of the lower quality market. And, again, I think it really depends on why you own fixed income. If it's purely from an income perspective and you want as much income as possible, that's fine. You just got to be willing to take, there could be a lot of volatility. If you're there from an asset allocation perspective and you want to balance other parts of your portfolio, I think, that's where you have to be really aware of those risks that you're really taking on within the high yield market.
Yeah, interesting. Good insight there on that space. One of the topics that we talk a lot about is duration. when interest rates were 0, 1%, you had to go short duration, right? Because there's only one way for interest rates to go.
Yeah.
A lot of people are still talking about short duration, and interest rates are, for that four handle, 4.5%. Do you agree? Do you agree that right now is still a good time to be shorter in duration?
Yeah, I think intermediate is how I would probably look at
Okay.
it. Intermediate fixed income, which, call it 2 to 7 years, I think makes a lot of sense today given the issues that we could see down the road. I think a risk out there is, what do long-term treasuries do? What do long-term corporate bonds do? Because they're kind of related to long-term treasuries in a lot of ways. Do in an environment where maybe there's more inflation, investors don't buy dollar assets, our long-term rates rise. And, if you think about what's happened with the yield curve year to date, at least as of a couple of days ago, the 30-year treasury really hadn't moved that
Yeah.
much, while twos to sevens have shifted down quite a bit in response to the Fed probably cutting interest rates. So I think intermediate gets you a lot of the yield that you could earn versus owning an entire portfolio of 1 to 30 year bonds in a lot of ways, but takes away a lot of the volatility um, out there. And so I think it's definitely something investors got to be aware of, similar to the high yield and the correlations is, not all bonds are created equal, right? There's different parts of the
Yeah.
yield curve, and the different parts of the yield curve move for different reasons. And so, again, active managers figure out what the best part of the curve to be in, and we invest accordingly. And an investor that, loaded up on very long duration, long maturity treasuries really hadn't seen that much performance. And in fact, on a year over year basis, is negative versus
Mhm.
the intermediate part of the curve, which had a pretty strong positive total return. So it's definitely something that we're aware of, and
Yeah.
why we focus, kind of to your point about more be the short term, intermediate, makes a little bit more sense now, just from a risk reward, especially for those investors that are sitting in cash and they want to maybe
Yeah.
not take as much risk, move out a little bit. Well, maybe intermediate makes you get a little bit more yield than the cash. You lock it in, but then you don't have as much volatility as maybe the long end would provide.
Yeah. That's a great point, Mike. If you are hesitant, a financial advisor, you have some clients that are hesitant to jump in the fixed income. Yeah, go shorter, more intermediate duration, a little bit at a time, dollar cost average. Seems like a good strategy. Let's go there real quickly. you know, do you have any tips when, there's financial advisors out there that are trying to allocate to fixed income now because it is attractive, yields are attractive, diversification, a lot of benefits to fixed income. Do you have any tips out there for financial advisors who are trying to create that investment portfolio for their clients?
Yeah, I would say in today's environment of tight spreads and I would say a skewed distribution in terms of possible outcomes to maybe the negative side. I think
Yeah.
higher quality and really knowing what you own is really important right now. I mean, there's a lot of complexity in the investing world, and I think, transparency and knowing what you own and higher quality are things that you can easily explain to your client.
Yeah.
If you have a separately managed account and you see that you own a JP Morgan Chase bond, I think there's a little more comfort there by seeing what that investor has in their portfolio. There's not just a ticker and there's a whole bunch of stuff going on underneath. I think the transparency of seeing what you have in a portfolio is a big benefit when you're talking to clients. And I think in this environment, you don't have to be overly complex to earn a good amount of income and kind of provide that overall diversifier from a risk perspective.
Mike, that's fantastic. I'm really glad you brought that. I have so many conversations about some of these active ETFs out there, and there's transparency in active ETFs, but some of them are so complex. As a financial advisor, I'd be like, I don't know. I
Yeah.
can't understand them. How do you have that
Yeah.
conversation? And then if it blows up, how do
Yeah.
you have that conversation with some of these inverse leverage three
Yeah.
times?
Yeah, it's interesting. I saw there was a United Healthcare 2 times the United Healthcare. They just pop up out of the blue whenever there's volatility and something in vogue. They create a new ETF. Regardless if it's our SMAs or our funds or our active ETFs on the fixed income side, it's very what you own in all those. You can look at the holdings, you see
Yeah.
exactly what you own. And I definitely think it creates a sense of comfort if you're allocating to that, and you can kind of explain it to your client that well, this is what you own. They're doing their work. You're safe, and you're good. You're good.
Yeah, you're exactly right. And investors now, it's changed over the years, but they want to know what they own. They want to have transparency. And I think it's so important to know what's those underlying investments because if it does happen to blow up, you can explain to them potentially why or what happened, and it's important to understand it. You don't want to come back a couple years later and not being able to explain what
Yeah,
happened to that ETF or whatever. So very
100%.
good point. Mike, thank you so much for coming on the show. Really fun conversation. You shared such great insight, really interesting stuff. Where can our audience get more information about Madison Investments?
Yeah, it was great being here as well. Thanks for having me. Yeah, if you go to madisoninvestments.com, you can see all of our different strategies that we have here at the
Okay.
firm, and we also have some commentary and topical information there as well to kind of see what we're thinking about and how we're viewing the different types of investing environments that we're seeing nowadays, and kind of get good perspective on how we're attacking that from an investment portfolio.
Yeah, fantastic. Leading up to the conversation, I went to your website. You guys do have a lot of great content, market commentary. Love it. Highly recommend it. So next time I'm in Madison for a Badger game, can I stop by? Maybe we can do this on site.
For sure. Yeah, come into our office. We got a beautiful office, and we'll catch a Badger game in the fall. I don't recommend people coming in February necessarily, but any time from about June to October, it's great. Yeah.
Awesome. Mike Sanders, thank you so much for coming on the show. Really, it was an honor, fun conversation. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. And please be sure to subscribe to those channels and follow us on LinkedIn. Thank you very much and have a great rest of your week. Mike.